How to beat 99% of all investment managers as a new investor. Every investor starts investing to grow their investment amount, right? That is the dream. But how do they do that? Simply, if you can understand the market, you can beat the market. But can new investors do that like those investment managers who have been in the market for a long time? What if I tell you that you can? Actually, you can beat 99% of those managers, and in this video, I will be talking about how. So stick with me until the end. Are you thinking about what exactly beating the market means? Let me tell you that it means an investor or corporation seeing better results than an industry standard. Too techy? It simply means to perform well with the market's point of view. So, if you spend much time on the market, you will understand the market better and have a higher chance to beat the market, don't you think? So, new investors have a lower chance from that point. I have researched the market for a couple of weeks to figure out that logic and found 3 ways actually new investors have a higher chance to beat the market than those investment managers. Let's dive in. Before I get into the details, let me clear up some investment topics that most investors face when they start. Active and passively managed funds, which are better? A passively managed fund simply follows a market index. It does not have a management team making investment decisions. Market index refers to a portfolio of securities that represent a particular section of the stock market, as they don't need managers, making passive funds cheaper to invest in. Index funds like S&P 500 and NASDAQ follow a passive investment strategy. John McQuone and David G. Booth established the first 2 index funds in 1973. Before index funds, people had to choose from a variety of stocks and build a portfolio of stocks. But index funds provided easy diversification, simplifying the entire investment process. Dollar cost averaging is a popular strategy that can be combined with index funds for a better result. This strategy involves consistent investments over the long term, both in terms of dollar amounts and how often the investments are made. An investor divides up the total amount to be invested across periodic purchases of target assets. The goal is to reduce risks related to market timing by investing regardless of how stocks are performing. Regardless of the price of the stock you buy. Combined, even the most inexperienced investor can develop a well-balanced portfolio that doesn't expose itself too heavily at any one risk. In an actively managed investment fund, a manager or a management team makes decisions as to how to invest the fund's money. I bet you have heard the terms hedge funds and mutual funds, which are managed portfolios by managers' investment capital from multiple investors to achieve returns through diversification. They charge a management fee and a performance fee, which is higher than index funds. Currently, actively managed investment funds typically underperform compared to popular market benchmarks index funds, as 18% of active fund managers have managed to beat their benchmarks over 15 years. But what do you think the system that they or any other financial institutions follow? Actively managed funds tend to invest in assets that can provide them good returns on investment, or ROI, within a short time frame. Managers prefer liquid assets so that they can shift from one investment to another quickly. Beating the market means beating those investment managers, and it needs time to do that. But as the fund managers took for short-term investing, it becomes very difficult to achieve their benchmarks. So, to the main topic of the video, how can you beat them? Number 1, ignoring short-term results. As I said earlier, actively managed funds look more for short-term results. Investors are more likely to react to short-term underperformance, so fund managers can't afford to take a short-term perspective. According to research, in 2019, the average actively managed domestic stock fund has an annual turnover of 63%, meaning a fund made up of 100 stocks would replace 63 of its holdings in a given year. As a new investor, you can focus to invest with a long-time horizon of 5 to 10 years or more. When you take a buy and hold approach, which is followed by Warren Buffett himself, you can ignore short-term volatility to focus on long-term results instead, so that gives you a higher chance of beating the market. Number 2, invest on real growth potentials. One edge you will have over big active managed funds is that you can invest in small cap stocks, those issued by a company with a market capitalization between $300 million and $2 billion. Because those funds are often too large to invest a significant amount in any given small cap stock, they are prohibited from acquiring more than 10% of an individual stock's voting securities. The small cap stocks are worth less than the blue chip stocks, which are huge companies with an excellent reputation you'll find in much of the S&P 500 index, but they have greater growth potential. Of course, they include risk, but you can identify an up-and-comer by finding out about it more, and you can earn a hefty profit by investing while the stock is still a bargain. Number 3, don't get shaken out of good positions. Though it is obvious, the companies don't have a golden run for an eternity. What I'm trying to say is, there comes times when a company's stock can stumble pretty badly. Like in 2019, Facebook, Alphabet, and Amazon caught up in a regulatory and political firestorm, and investors along with several fund managers took the risks of government intervention too seriously. Look at the companies now still booming. So, it is easy to get spooked by stock pullbacks. The key to navigation, though, is understanding whether a business model is still sound. According to a market analyst, that is half the battle. It's not just identifying them, it's not getting scared off the horse. So, unlike those managers, you can just analyze the company business, and if it is a major setback that the company will overcome, you can stick with them and reap the future benefit. Pretty cool, right? So, long-term investing is always a good investing strategy. Want to know about some stocks that are good to invest in for the long term? Take a sneak peek at this video link. That's it from me about how to beat 99% of those investment managers. For those new to the channel, remember to like this video and subscribe to join the Six Figures Club and follow along on the journey to wealth.